Welcome to Retire Right with Rick Durkee, presented exclusively by the Coastal Financial Planning Group here on News Radio 94.3 WSC. Rick Durkee is the retirement income planning and wealth distribution specialist in the Lowcountry. Are you ready to retire right? Here's your host this morning, Shane Griffin.
Good morning. Welcome in for another edition of Retire Right with Rick Durkee. I am your host, Shane Griffin. Each and every Saturday morning at 9 o'clock, I have the privilege of sitting down with our local retirement, income planning, and wealth distribution specialist, Rick Durkee, to help you to retire right. Good morning, Rick. Good to see you, sir.
Hey, Shane. Good morning. Glad to be back here on the airwaves with yourself and
Absolutely.
our listeners here, 9 a.m. Saturday mornings.
Hard to believe we're wrapping up February. This year just continues to roll on by us.
I know.
Where is the time gone?
Well, Shane, we had so many topics we wanted to get in, with this year. And then here we are rolling through February, and we're going to talk a little bit today about the inconsistency of the 2015 markets.
That's
and this
right.
is the first chance we've had to talk about it. So,
absolutely.
But, we still see volatility now, and people are concerned. What can we do in these inconsistent markets? So I look forward to having that conversation
that's the topic,
with you today.
How to produce consistent results in inconsistent markets. Before we jump to the topic, and it's very detailed today, so I hope you're listening carefully and closely. And again, if you missed the program, or if you catch the tail end, or if you miss it altogether, you can always go back and listen to the program at the podcast page at 943WSC.com and also at cfpgroup.biz. Before we get to the topic, Rick, Walk for Water coming up on March the 12th. Wanted to give you another opportunity to chat about that for a moment.
March the 12th, everybody's meeting at the Joe from 10 o'clock till 1:30. The Walk for Water will occur. It's an annual event now that's been organized by Water Mission. And Water Mission's objective is to provide safe drinking water across the world to places that do not have safe water, and also to be able to promote the word of living water, Christianity, and help people to learn about that. So Water Mission will be organizing this event. We will actually walk for about 1.5 miles with empty buckets. No race here, just a walk to get to water, to get to clean, safe drinking water, and then we'll each carry our individual buckets back to the Joe and finish up for the day 1.5 miles later with water buckets full, and then we'll place them back into a water filtration system that Water Mission uses across the world to provide safe drinking water. So you'll get to experience how people that are less fortunate than us, that don't have safe drinking water, how they have to walk for their water. And it's a great opportunity. It raised last year over $350,000 for the Water Mission, and it is an international organization that's based here in Charleston.
Right. For more information on this, you can visit walkforwatermission.org, walkforwatermission.org. Rick, let's go ahead and jump to the topic. For investors, 2015 was a rough year. Commodities took a beating, treasuries lost, bonds were volatile, and even Warren Buffett's Berkshire Hathaway was down 11%. Exclamation point. Warren Buffett had a losing year.
Yeah.
Last year was one of the hardest years for investors since 1938. It was
the year my parents were born.
Really?
Yeah.
Interesting.
77 years ago, folks.
Very interesting. It was also the first losing December, Rick, since 2002. All of these factors contributed to the volatility that investors experienced in last year. However, none of these factors provide an answer to the basic question on everyone's mind, Rick. How do I make money, and how do I protect myself in this sideways and unpredictable market? I mean, we are seeing volatility raise its ugly head for sure.
Well, Shane, certainly it's a concern. It's up, down, it's all around, and then it ends up where it was before, but a little bit less. Okay, are we seeing a trend here? I will share with our listeners this morning that most of our institutional managers for our clients that we use their models for are risk off, and we haven't seen an opportunity to go into that looks like it's worth the risk of the potential down. So, as any investor who relies on a portfolio for their retirement income, certainly an inconsistent market can be one of the biggest killers to their retirement. Studies have shown that losses early in retirement can be catastrophic to a portfolio, especially when you are withdrawing money out of that portfolio.
Double whammy. Yeah.
Yep. So we have that sequence of returns risk, and sequence of returns is certainly something that we need to be aware of. The sequence of what your money earns over time. A good example of this is a math equation, Shane, and I'll take a few minutes to discuss this. Let's say that you had two couples. They were identical in many ways. The main difference is that couple B, we'll call them, retired 4 years later than couple A. Okay. So now this talks about past performance. It's hypothetical, but what we always need to remember is no past performance can predict any future results.
Right.
And this scenario that we're talking about of this sequence returns would never duplicate itself with returns in the market. However, we can learn from it if we spend a few minutes on it. Couple number A and couple number B both retire at age 65.
Okay.
They both have $1 million. They both want to withdraw 5% out of those assets.
Okay.
They both index their payments every year 3% for inflation. So they're doing everything identically as far as how they're withdrawing off those assets. Couple number A gets a sequence of returns during their first 4 years of retirement and repeats that cycle every 4 years for the remainder of their retirement lives. Okay. Couple number A earns an average of 7%. Couple number B also earns an average of 7%.
Okay.
Okay, this is one of those old word problems,
Yes, it is.
isn't it, from school?
How many apples do they have?
All of our listeners right now are saying, what? Okay, so they both have all those identical situations, except for one now that is the big distinguishing factor. In the couple A's sequence of returns, they earn a positive 27%. Then they earn a positive 7%, a positive 9%, and then they get hit with a negative 15%.
So plus 27, plus 7, plus 9, minus 25.
Yeah.
Okay.
Yep. So now couple B starts 4 years later, okay, and the markets act differently. And in this scenario, again, it's hypothetical. They're still averaging 7%, but we take 27% and now we put it on the back of those 4 years. So let me give you the sequence for couple number B. They start with a negative 15.
Okay.
They have a positive 9. Then they have a positive 7. And then they have a positive 27%.
Right.
Okay. And they continue that same cycle all the way through retirement. All right. So everybody's got the same except for the sequence of returns.
Right.
And everybody is withdrawing the same amount of money throughout the remainder of their retirement years, starting at age 65. Here's the big difference. Remember what amount that they were taking out per year to start with?
5?
50. 5%.
Right.
$50,000 out of $1 million.
Yep.
Yep. I'm not even going to do the math on taking that and taking inflation and adding it out over the remainder of their years. Okay. But if you take couple number B, their money, just because of the sequence of returns, because they had the loss up front, even though it wasn't as big as the gain on the back end, the 27%, they lost 15% up front. And then they had a positive, and a positive.
Right.
Their money runs out 13 years sooner than couple number A.
Incredible.
13 years sooner. 13 times $50,000, if we use simple math without inflation here, folks, is $650,000 difference.
Wow.
Which couple do you want to be going throughout retirement? Okay.
Well, yeah, you want to be A.
You want to be couple number A.
Yeah.
You want to have a successful retirement. So everybody's sitting out there right now saying, how do I avoid sequence of returns risk? Okay. You have a managed money platform managing your money to minimize the downside on your investment or risk side.
Right.
And then you take a certain amount of your assets, as the book that I've offered in the last 2 Retire Rights describes, Income Allocation by David Gaylor. You take a certain amount of your assets and you place them to the side and you say, this is earmarked for future income. I'm going to create a pension check with that. I'm going to use the guarantees of an insurance company to create income through a annuity product of some sort. Okay? So that's how you avoid sequence of returns risk on your money that's paying you out income during your retirement, because products that use underlying principal protection and guarantees called deferred fixed indexed annuities give you a 0% floor in a down market. You just took out sequence of returns risk. Now all you're doing is comparing, wow, if the market goes down and I get a 0 in the first year instead of a negative 15, you've minimized sequence of returns risk. Okay? And you've got nothing but zeros and positive numbers all the way through retirement for that income-producing asset.
And if I may, and correct me if I'm wrong, you've got a one-sheeter or a white paper on sequence of returns, correct?
I have a resource piece that's provided by an insurance company, and be happy to send that out. It is called Sequence of Returns Risk. I use it in my seminars, and we have copies available if people want to email me at rick@cfpgroup.biz or call us at 735-5065.
It definitely is worth the time to sit down and walk through. I mean, we gave you a quick example of the sequence of returns risk between couple A and B, but just sit down and see that chart and that graph. It really kind of is an eye-opener for sure.
For those people that aren't auditory learners, they're visual learners, certainly call us and we'll send you a copy.
Well, as we've talked before, and we'll continue to beat the drum of having a process in place when it comes to retirement income planning. You've been talking about that for years. In an annual study of investors, Rick, conducted by Dalbar, the nation's leading financial market research firm, found one of the primary reasons why small investors, retail investors, us, fail is due to their investment process or lack thereof. The Dalbar study found that most small investors made investment decisions based on their perceptions or their instincts or maybe even feelings about the market. This lack of process often leads investors to make decisions that are not in their best interest, doesn't it, Rick?
It does, because they are based on underlying reasons as to why that information is given to them, Shane. I had a prospective client come in a few weeks ago, and they had been introduced to us, and we got into a discussion about deferred annuities. Now, annuities are often maligned in the press. Right. All right? Yep. And this particular person, I've heard this many times, she said, I read online and saw plenty of articles here that annuities are bad.
Ken Fisher hates annuities.
Ken Fisher hates annuities, absolutely. Yep. And so then, again, you look at what is that source of financial advice that you're getting that information from. And I asked her, where did you get that information? What article was it? Who published it? Right. Forbes magazine. And I asked her one question. I said, who pays the bills for Forbes? Who does the advertising in Forbes magazine? Okay. All right. It's Wall Street. Yeah. All right. Yeah. And Wall Street does not manufacture annuities. Insurance companies do. All right. You can get annuities through brokers. All right. Typically variable annuities that are manufactured with Wall Street investments, underlying Wall Street investments. But, you got to look at the source of the facts. And then you got to see what's in it for that particular source of financial information that you just educated yourself with. And then you need to take it and you need to write down some questions, and you need to go seek good counsel that will help you walk through those myths, misconceptions, and incomplete facts that you're getting and learn why they're provided to you. And then you can certainly make some sound financial decisions going forward. Now, let's get back to the discussion of Dalbar here, Shane. What concrete signals and experiences do small investors have to rely on? All right. They have the media. They've got Kramer. They've got
CNBC.
CNBC. Oftentimes the only signal that small investors have to rely on is their own perception of the markets, markets, plural. Okay. But all you ever hear is what the Dow did today, or what the S&P 500
S&P,
did.
and the NASDAQ.
That's it. Yeah. That's it. Those are benchmark indexes. And are you totally invested in those three asset classes? I hope not. because if you are, then when those go down, all your eggs are in one basket.
Yeah.
Okay.
Right.
So do these sources that are providing these individual investors perception of what's going on in the markets provide information that help you think that prices will go up or prices will go down? In other words, following the actions of the masses. It's known as herding, Shane.
Mm-hmm.
Herding goes back to the original days of
caveman.
The caveman, exactly. I mean, he's chasing after this animal, and it herds with a bunch of other animals, and they run away, right? Mm-hmm. So they make decisions as a herd as to what to do based on fear. Mm-hmm. All right, so it's that herding mentality that gets us in trouble. Everybody's talking about how much money they made in their investments. Let's get in.
That's right.
Oh, it's high. We forgot to mention that the market is high right now.
It's at its peak.
It's a great time to buy, right? When it's high? No, not really.
Buy
because
high and sell low.
Where's it going to go from there?
Right.
Yeah, buy high, sell low is typically what the retail investor does. Small investors on a simple investment platform will see scattered results with unpredictable and uncorrelated gains and losses. Mm-hmm. This retail investor has the problem of the lack of consistency in their investments. This is going to provoke anxiety and help them make bad decisions, because in most cases, most investors will continually switch investments and strategies to remain in the paradigm of buying high, as you just mentioned, and selling low.
Mm-hmm. For additional information on the topics we are discussing this morning, 843-735-5065, the number to call. Check the website for a calendar of events and to listen to past programs, including this one, cfpgroup.biz, cfpgroup.biz. So, Rick, now let's compare this emotional small retail investor, which typically is us, me, to the systematic institutional platform and that professional investor that has a process and a system in place for investing retirees' money. I mean, when you compare those two, the small retail emotional investor really has no idea what they're up against when you're talking about the systematic institutional professional investor.
Well, Shane, I want to put myself in everybody else's position right now that might be a retail investor or be receiving advice from sources that have their own best interest at heart, and talk about that I opened up my wife's year-end 401k statement. Now, we don't have the ability, or I would, to transfer her assets out of that 401k. Mm-hmm. It's with a large employer, and she has to wait until she's 59 and a half to be able to move that money into her own IRA. Right. But what that means is we have to be an individual retail investor with that money. I have to make choices for her. Mm-hmm. I'm involved with my everyday life. All right. Things go up, things go down. I think maybe we should move into the bond market when the stocks are, doing what they did last year. Yep. But I don't find time to get her and go call Fidelity to make these changes in her 401k. I get the statement. And guess what? At the end of last year, we were positive. Okay, we had positive growth last year.
How about that?
And I say, wow, I did such a great job. And most retail investors would be happy if against the benchmark of the U.S. domestic stock market that they were positive. Right. All right? Here's my point. That's at a point in time, okay? So I did well last year because I couldn't put it in a rules-based strategy, okay? I didn't have that option. And so what I'm going to talk about here for the next few minutes is very important. We need to talk about having an investment policy statement. This is a plan that you follow that's going to be governed by your risk and how much risk and propensity you have for loss. It needs to be in writing. It needs to be thought through. It needs to be, hey, if this does this, I want this. Right. All right? And retirement-minded people have to know that if this, meaning your investments, do this, which means go down, I want to know that at a certain point, that's where it stops. Right. I don't want any more drawdown. I don't want any more measurement of an investment's performance from peak to trough. So these are rules. These are rules that are followed, and when you use a rules-based strategy, then by using that approach to investing, you are pretty much locked in. Okay, now you can move out, you can change. Let's say that the markets are not performing adequately right now, and you are risk off, and then all of a sudden, one of the asset classes that you're in starts working well. You can go back in. You can have management that has discretionary trading authority that will automatically put you back in.
Right.
You could say, well, you know what? I really did like to invest when the market was going up. It was easy then, the stock market, the U.S. domestic stock market, and it dropped. Let's just say that in the past it dropped, and now it looks like it's going back up. I want to put more of my assets at risk in the U.S. domestic stock market. You can do that. You can do that when you sit down and develop a proper investment policy statement so that your advisor knows when to move you back in and how to move you back in after the loss period. So statistically, by using these rules-based approaches for investing, institutional investors have these models in place already, Shane, and they're able to realize greater returns than retail investors by changing the paradigm from buying high and selling low to buying low and selling high. Now, no investment is perfect. It is going to lose money, okay? This does not mean that institutional investors don't go backwards. They do, okay? They lose money, but it's within what your investment policy statement says that you are willing to accept for loss, because we know risk and reward are traveling companions.
Right.
If you want to take risk and you're willing to go down, you will over time have a greater probability of having higher returns. Now let's put this in perspective to who you referenced earlier in the show today. Warren Buffett lost $2.5 billion in a single week.
What?
Okay? Yeah. However, by following a process that dictates their every investment action, an institutional investor like Warren Buffett is going to be able to shift the proportion of trades that are wins to their favor and provide greater returns for investors over the long term. You've got to be invested for the long term, folks.
Well, it should be noted, too, that you have a registered investment advisor platform called Precision Capital Management. We have just a few moments. If you could talk about what that is and what that gives someone listening this morning. What's the advantage of dealing with an RIA platform?
A registered investment advisory platform has to work under a fiduciary capacity for its clients and understand that any decisions need to be well thought out and follow the investment policy statement, Shane. I have to offer this disclosure right now because you mentioned them. Investment advisory services are offered through the Coastal Financial Planning Group as an investment advisory representative for Precision Capital Management, who's an SEC registered investment advisor, and the firm only transacts business in states where it's properly registered, which it is in the state of South Carolina, or excluded or exempted from registration requirements. SEC registration is not an endorsement of a firm by the commission and does not mean that the advisor, as in the case of the Coastal Financial Planning Group, has attained a specific level of skill or ability.
Glad I brought it up.
Yeah. Hey, if you want more information on this, visit the website, cfpgroup.biz.
cfpgroup.biz. 1 minute to go, Rick. Before we let you go, you'd like to offer that book, Income Allocation by David Gaylor, correct?
Absolutely, Shane. And so that was the last 2 weeks. What I want to offer today is, other than the podcast, for those visual learners out there that want to read, we have the white paper that we made available to our clients on investing in an inconsistent market available. We can provide that. It was today's topic today. It will go into much more detail than our 25 minutes gives us on a Saturday morning here. So certainly email us, rick@cfpgroup.biz, and we will send you out how to produce consistent results in inconsistent markets.
There you go. Always great to see you, sir, and we will see you back here next week. We kick off March incredible next month.
All right. Thank you, Shane. Thank you to our listeners this morning. Join us again next Saturday morning at 9 a.m. for another half hour of Retire Right with Rick Durkee.